Hello and welcome to this installment of Modern Business Accounting Principles. Today we are up to chapter 19, Proprietorship, in this book that is copyright 1936, Alexander Hamilton Institute. Now a lot of this chapter will be focused on share ownership of a company, so we're probably going to skip over most of that, but there is some really interesting information at the beginning about sole traders and partnerships, so let's jump in. So proprietorship as a concept in accounting is the first section. So proprietorship in the accounting sense refers to the rights of the ultimate owners of an enterprise as expressed in many terms. So there are multiple terms. There's also multiple terminology. So we say proprietorship, capital, owner's equity, owner's rights, ownership, lots of different ways of terminology as well as ways of defining that. By ultimate is meant the final or residual rights after the claims of all others have been accounted for. In the conduct of practically every business, it is necessary to obtain capital from individuals other than the organisers. In a sense, the creditors are proprietors, but their interests are not classified in the proprietorship. So we're suggesting that funds come not just from the owners. So any time a creditor, so somebody you owe money to, gives you credit, they're actually funding your business because they're providing you with goods or services that you haven't yet paid for. So we have to be careful throughout our discussions to distinguish the liability accounts from the proprietorship or capital accounts, although both are listed on the left-hand side of the balance sheet. This is an important distinction, but it is not always an easy matter to determine just whose equities are included in the two classes. I'd say that's probably not quite true, but I do appreciate the idea that extension of funds or extension of credit terms from creditors does form part of the fund of running a business. It has been convenient in developing the principles of accounting to speak of the business as an entity separate from any of the individuals whose interests are involved. Thus, we say that the business owes the creditors the amounts shown in the liability account. We do not say the proprietors owe the creditors, although in a legal sense that is often the case. Furthermore, the statement is usually made that capital is the difference between the total amount of the assets and the liabilities. Just what is the fundamental distinction then between the outside liabilities and the proprietorship claims? The question can be answered only by an analysis of the relationship between the interested parties and the enterprise considered as an entity. So it's just asking the question, how do you actually determine the proprietors from the other parties that are involved in the funding of a business? Differences arise in the terms on which the capital is supplied. The creditors have certain definite claims as to the repayment of their investment and as to the amount of income that shall be paid. So if you do have credit terms with the creditor, you've got a fixed amount of what will need to be paid and when it will need to be paid. The same with loans, with bank loans or mortgages, there's a fixed amount to be repaid by a certain time. The proprietors, on the other hand, have no contractual rights either to a return of the principal or of income. Their claims are strictly residual. So a proprietor, there's no guarantee a business is going to make money. There's no guarantee the business won't become bankrupt or go into administration. So that there's not even a guarantee that they will actually get their original investment returned to them. Normally, there is also a distinction on the basis of risk involved. The proprietors assume more risk and control, whereas the creditors assume less risk and exercise very little control. Even in this respect, the difference is one of degree rather than kind, for everyone who invests funds in a private business venture assumes some risk of loss. So it's saying even it's just the amount of risk that an individual or business actually takes in an enterprise. So thus, it may be seen that both the creditors and the proprietors furnish the same types of services, namely capital, risk-taking and control. One may be distinguished from the other by the degree to which these services are assumed. The proprietors assume the greater amount of risk-taking and control, whereas the creditors furnish primarily a capital service. So that's the difference between a creditor and a proprietor. So then we go into sole proprietorship, so sole traders, sole business, solopreneur. The simplest form of business enterprise is the single proprietorship. From this standpoint of numbers, this type of organization is far in the lead. Anyone who produces a commodity or service for sale is a proprietor. There is little accounting significance to his proprietorship, however, unless he has some capital invested in the enterprise. So anybody that sells services, even as an employee, can be seen as a proprietor because you are generating income and generating expenses. But unless you have invested capital into an enterprise, you're really not actually a business. So in this form of organization, the line is clearly drawn between proprietorship and liabilities. The proprietor usually has entire control of her investment, and this constitutes the greater part of the capital. Then the interests of the proprietor are more closely identified with the actual ownership of the enterprise. From the legal standpoint, the proprietor is the business. She owns the assets and owns the liabilities. The business does not exist as a separate entity, and if there are insufficient funds in the business to meet the liabilities, the creditors may force payout from the proprietor's private estate. So that is a sole trader. As a sole trader, if that's how your business is registered, legally you and the business are the same individual. But it's much better for you to think about them as two separate entities, separating their banking, separating their bookkeeping, separating their income and expenses. The capital accounts, we then go into the actual capital accounts of sole proprietors, are very simple. There is no question as to the distribution of net profit, since the balances of the expenses and income accounts are carried directly to the proprietorship account. So there's no need for dividends or division of shares or division of profit, because everything flows, every profit from that business of a sole trader flows to the sole trader or the owner. Then goes into withdrawal of salary, but you can't actually withdraw the salary from a sole proprietorship because, where's the example? It's taking money out of one pocket and putting it into another because they are actually the same entity. So although sometimes salaries are recorded, they're not actually ever expensed. That's not allowed under the legislation either. So then the second form of proprietorship, partnership. A partnership is an organization of two or more individuals who have agreed by contract to combine their capital or other interests in a business venture for their joint profit. The contract or agreement may either be written or oral and is binding between the partners. It is always desirable to have a written contract setting forth in detail the rights as to investments, division of profit, rights in case of dissolution, etc. This precaution reduces the chances of disagreement and even of legal disputes, and that's very true. If you are going to get into a partnership with somebody, even if that's your partner, life partner, husband, wife, boyfriend, girlfriend, it is wise to get that agreement put into writing so that you are covered and to get that done by a professional. From the legal standpoint, a general partnership is very much the same as a single proprietorship enterprise. The partners are jointly and severally liable to the full extent of their private estates for the debts of the enterprise. So both partners are responsible for the debts of the business. From an accounting standpoint, the partnership is different from the sole proprietorship enterprise because there is more reason to look at the business as an entity because the combination of two people creates a third, kind of a third party almost. And then we go into how to use partnership capital accounts because obviously then if you're talking about partnership, the profits are going to be divided by the number of partners, whether on an equal basis or on the basis of the partnership agreement. And it gets a little bit technical on if you're going to be charging in salaries and if you're going to be doing drawings, loans to and from the business. Then we get to corporate proprietorship. So this is what we often think of when we think of a company. So a company differs from the sole proprietorship and partnership forms of an organization in several respects. In the first place, a company is recognized in law as an artificial person created either by special act or under the Companies Act. The rights and privileges granted to a company are strictly limited to the purposes for which it is organised, but within these limitations it may act in every way just as though it was an individual. So if you have a company and it is registered, it actually does have legal status as its own individual or person, not person as in human. This means that it may own property, enter into contracts, incur indebtedness, and it may sue and be sued in its own corporate name. So then takes away that liability, or can take away that liability of the owners to cover the debts of the business. There is some legalness around that, but that is the aim of a company, is to take away that liability of the owners. Then it would go into security issues or shares, fixed preference shares, participating preference shares, lots of different versions of shares. So this book was written to allow the business executive of the 1930s to understand the ownership of their business. And obviously this book, even just by the length of it and the detail it goes into, wasn't written for the owner really of a sole proprietorship, and probably not even for a partnership, but an executive in a business that would have been owned by shareholders. And it goes on for quite a lot, talking about which accounts need to be set up and how the bookkeeping needs to take place with capital, and when capital is called. So if you're asked to submit extra money, paid up capital, reserves, there's a lot of information. And to be honest, that's the end of the chapter on proprietorship. So it is a short one, but it is really useful to understand the difference between how funds are contributed to the business is what constitutes whether you have an ownership stake in a business or not, and that any partnerships should be formalised, and that a sole trader and the sole trader's business are one and the same individual. If you've enjoyed this video, please hit like, leave a comment on something that intrigued you. And if you want to see more of these videos, please subscribe. And until then, I'll see you next week.